If you've ever wondered why some people swear by whole life insurance while others call it a scam, this series is going to clear it all up for you. I'm going to be breaking down the 30 most common questions that people have about how whole life insurance actually works. This is the kind of stuff that the financial industry never takes the time to explain. By the time we end this 6-part series, you'll understand why the wealthiest families, banks, and business owners all use whole life insurance as core financial foundations in their life, and why so many others misunderstand it completely. In this first video, we're tackling the first 5 questions, starting with what whole life insurance actually is, how it works, and why it's so different from term and IUL. My goal is simple: to help you see how whole life insurance fits into building a life that truly matters to you, one built on clarity, control, and alignment with your values and beliefs and goals. So let's dive in. All right, so the first question: what is whole life insurance and how does it work? Whole life insurance is one of the most misunderstood financial tools in existence because people try to compare it to an investment instead of understanding it for what it really is, which is a savings and liquidity foundation that gives you control of your cash. At its core, whole life insurance is a contract with a mutual life insurance company that guarantees 3 things. First, that a death benefit is going to pay out no matter when you die. Second, that a guaranteed cash value is going to be included that increases every single year. And then third, guaranteed premiums that can never go up. But here's where it gets really powerful. Whole life isn't just about what happens when you die, it's about how you can leverage it while you live. So when you pay your premium, part of the money goes towards the insurance costs and part of it builds up inside of the cash value in your policy, which is basically like a private savings account inside of the policy. It's why we call it a banking alternative, right? That cash value grows tax advantaged without market risk, and you can borrow against it at any time without interrupting the compounding growth of your money. So in cash flow hacking frameworks, we look at whole life as the core liquidity engine that makes everything else in your financial life possible. It's where you store your opportunity capital, so when life happens or opportunities come, you don't have to sell investments or go into debt to make it happen. The key mindset shift is this: whole life isn't about chasing returns. It's about creating alignment between your money and your life. It's a tool that gives you clarity, control, and confidence. 3 things that Wall Street doesn't sell. That's why at Life 180 we say whole life isn't the investment, it's the foundation that makes investing possible. All right, so question number 2. How is whole life insurance different from term life or IUL? All right, so this is probably the most common and misunderstood comparisons in the financial world completely. On the surface, all 3, term, index, universal life, and whole life, are all just life insurance. A lot of people just compare them to each other and think they're one and the same, but under the hood, they're actually completely different tools designed for totally different purposes. Term insurance is simple. It's pure death benefit. It's protection for a specific period of time, whether it's 10, 20, 30 years or something like that. It's cheap because statistically, you're probably not gonna die during that term. It's great for temporary needs like protecting your income while your kids are young, but it's not designed to build wealth or create liquidity. It's basically like renting. I mean, these insurance companies know there's a 98% chance you're not gonna use it. So when the term ends, the coverage ends and you walk away with nothing and all the money you spent is gone. That said, I'm a huge fan of term insurance and the problems that it solves for you in the short term. So Index Universal Life is marketed as the best of both worlds. Part insurance, part investment, right? Like if you've seen the videos, you know what I'm talking about. But in reality, it's a product built around assumptions and moving parts. Interest rate caps, cost of insurance charges, policy fees, participation rates, all this performance is tied to market indexes. Now, those assumptions can change, and they will, and that means that your results in the policy are not guaranteed. The company controls the levers to how this policy actually performs, not you. Now, whole life insurance, on the other hand, is the opposite of that. It's not designed for speculation. It's designed for stability and control. The premiums are guaranteed, the cash value growth is guaranteed, and the death benefit is guaranteed. You don't need to worry about market performance or rising insurance costs or company illustrations that may or may not hold up over the long run. Now, in the Life 180 and cash flow hacking frameworks, we use whole life insurance as the foundation, not the ceiling of your financial strategy. It's where your savings live before you deploy capital into higher risk opportunities opportunities that align with your vision and values. Think of it this way. Term insurance is rented protection. IUL is speculative performance, and whole life insurance is guaranteed ownership and control. The reason I don't like IUL is because I don't believe in speculating with insurance. We can speculate in other areas of our life. Now at Life 180, we're not chasing returns. We're building alignment. Whole life isn't about what you can make in the market. It's about what you can keep, control, and leverage for the rest of your life. So question number 3, why is whole life insurance more expensive than term insurance? Whole life costs more because it's not just insurance. It's insurance and equity at the same time. With term, you're renting protection that disappears when the term ends. With whole life, part of every premium builds permanent cash value that you own, guarantees that will never expire, and liquidity that you can use while you're alive. You're not paying more, you're just paying differently to build lasting control instead of temporary coverage. This is exactly what I always talk about when I say the buy term and invest the difference people simply just don't understand. So question 4, what happens if I stop paying my premium? One of the biggest misconceptions about whole life insurance is that if you stop paying, you lose everything, and it's simply not true. Whole life insurance, especially when designed properly, is incredibly flexible. It gives you flexibility on the amount of payments and then how you can actually fund it. Once your policy has built up enough cash value, it can actually pay for itself through dividends or internal values, meaning that you can use that cash to cover premiums or reduce them or even make the policy fully paid up. This is all possible with whole life insurance in a way that no other policy can offer. The key difference between them is ownership. With term insurance, you stop paying and it's gone. With whole life insurance, you've built equity, and that equity gives you options. It's a living, breathing financial asset designed to adapt to your life, not a bill that you're chained to forever. That's the important thing that people need to understand with whole life insurance. All right, so question 5, and the final question for today, is what are the guarantees that come with whole life insurance? So I love this question because it's one of my favorite things to talk about. Whole life insurance is built on guarantees, and that's exactly why we use it as the foundation of the aligned wealth strategy. I've mentioned this a little bit already, I'll do it again. There are 3 main guarantees. 1, that your premiums will never go up. 2, your cash value will grow every single year. And 3, your death benefit is gonna be paid no matter what happens in the market, the economy, or with your health. But at Life 180, we look deeper. Those guarantees aren't just financial, they're psychological. They give you clarity, control, and confidence so you can focus on living your life instead of worrying about money. When I say this is the process of gamification of life, if we can guarantee the result, well, then we can have more fun in the process. Because true wealth isn't about chasing the highest return, it's about creating alignment between your money and your purpose. Whole life gives you that stability so every other financial decision you make is built on solid ground. All right, so those are the first 5 questions in this series, and if it helped bring you some clarity around what whole life insurance actually is and how it works, you're gonna love the rest of the series. In this next video, we're gonna dig into how cash value grows, how dividends really work, and why this isn't about chasing returns. It's about building alignment and long-term control. So make sure you subscribe and hit the notification bell because I don't want you to miss any of these. Each video builds on the last one, and by the end, you'll see how all the pieces come together and help you create a life that truly matters to you. And hey, if something clicked for you in this video, or if you've got a question you want me to cover in one of the next parts, make sure you drop it in the comments. I actually read them, I promise. In fact, a lot of our best videos are directly inspired from the questions that people post. So thanks for watching, guys. Have a blessed, inspirational day, and I'll see you in part 2.